Thank you everybody for joining us today on this Saturday for our second virtual first-time homebuyers seminar. Today we have Eddie Sama, again, from Universal Home Lending, going over the financing and loan options. And we have our wonderful two agents from Century 21 Global Connections Realty, Alma Tommy and Davor, who will be going over the real estate process and statistics on today's market and how COVID-19 is affecting real estate in general, if it even is affecting it. So I'm gonna go ahead and play this presentation from the start. Can you guys just confirm that you see it? Good?
Yes.
Yep. Go ahead, Eddie. You can go ahead and start.
Okay, good morning, everybody. Like I actually said, my name is Eddie Sama with Universal Home Lending. I personally have been in this mortgage industry for a little over 23 years. Experience as a mortgage broker, as a underwriter, as a licensed title agent. So I've got many years experience, and I want to share some of that with you today. So next, we're gonna talk a little bit about different aspects of the mortgage industry and mortgage financing, and then the professional realtors will get into their parts and really, dive into the current real estate market and, the buying process and so forth. A lot of information that we're going to be giving you. Please take as many notes as possible. And then moving on to the next one. Okay, so the most important thing to do when you are thinking about purchasing your first home is to become educated, is get as much education as possible, and you are doing that right now. By attending this first-time homebuyer seminar, you are at least starting the process of understanding what you need to do to purchase a home or get the financing necessary. And if you're not there, what do you need to do? What kind of plan do you need to put in place? That's important. I mean, you may not be ready now, which is okay, but sitting down with a professional, a mortgage loan officer, or with a realtor, and figuring out what's the plan that we need to put in place to get you to be ready in a month, to be ready in 2 months, 3 months, 6 months, however long it takes. Okay, so part of that is understanding, from my perspective, the lending perspective, what it takes to get you qualified. 3 foundations of any, this is the foundation of any loan. It's credit, income, and the assets that you have available to purchase a home and to put, a down payment and closing costs. And I'll get into all 3 of those areas. My recommendation is never pay for this type of financial analysis. You should not have. There are plenty of loan officers out there that will sit with you and analyze your current situation, and if need be, put you on a plan, and say, hey, Diesi, you're not ready now, but this is what you need to do. Let's take a look at your credit. After this, this action plan goes into play, we'll take a look at you again a month and a half from now or 2 months from now. And, you're 3 months away from the income that you need to qualify for this particular home that you need. Plenty of us are out there and willing to do that for you. And also credit repair. Everyone's situation is different, but if you can avoid having to pay for it, I would definitely avoid that, because there's a lot of things you can do on your own, and I'll get into that now. Any questions so far?
Eddie, don't put my business out there.
What's that?
Why are you putting my business out there?
I'm just using you as an example.
And when you talk about the lenders that are out there that help people put them on a plan, you also reference yourself in that, because you're
absolutely. Yes. Yeah, absolutely. I mean, that's I've been doing this so long that I understand that not everybody's ready at this moment, but you could be ready in 6 months, or you could be ready in a year. It's just a matter of putting a plan together. That's important for everybody.
Yeah.
Especially with first-time home buyers.
And the person receiving the plan has to be willing to follow through with it as well, too, because otherwise
You can lead a horse to water, but you can't make it drink.
Exactly.
All right, so we're going to dive into the credit part. Now, the important part of credit is not everyone is the same. Not everyone is in the same situation. Not everybody's credit is the same, and not everyone's credit will change or credit scores increase the same. For example, I had a young lady who had a credit score of 596. The only reason that she had a credit score of 596 is because she had two credit cards. That one was maxed out and the other one was over the credit limit. So I quickly had her pay those down, leaving just a 10% balance against credit limit. And in 8 weeks, her score went up to 660. Had another one with, actually, I have her right now with a 619 credit score. And it's taking a long time for us to get her credit scores up because she has other things besides paying down the collection. I mean, the balances. She has some collections that are pulling her credit down, and it's going to take a little bit longer. Not everybody's the same. So when I speak about credit, it's just general, and really it's more of an individual analysis of your current credit situation and what we need to put in place to get you to where you need to be. Okay, so I want to start with the minimum credit score that we're looking for. Okay, 640 or above right now. It used to be 620, but with the COVID changes and they're tightening up a little bit, guys. So now, in order to qualify for an FHA loan or a VA loan, you have to have a 640 or above. Okay, not to say that there's probably still a couple of lenders out there who are willing to go below that. I don't know how they're getting insured with FHA or with VA, but I'm just telling you 640 or above is where we need to be. The reason why is because of desktop underwriting or the direct underwriting approval that's necessary. What is that? Okay. When I sit with you and I review your income, I review your credit, the assets that you have available, I take an application, okay? I submit all that into Fannie Mae's desktop underwriting approval system. And let's say that we're going for an FHA loan. We're going for an FHA loan, and I plug all this information, your income, your work history, your assets, all of that is plugged into the application in the system. And I upload that into the Fannie Mae desktop underwriting system. It analyzes your profile, including your credit profile. Based on the program that we select, it will say, Diesi is approved eligible for this FHA loan, at 280,000 purchase price and so forth. Or it'll say refer with caution for whatever reason. That DU approval, we get that DU approved eligible is what you and your realtor need in order for you to make a strong offer on a property. I can write a letter saying that you're pre-qualified or pre-approved for 300,000. A letter is a letter. Anybody can type up a letter. But at the same time, what the listing agent and the seller are looking at, in addition to the letter from the mortgage professional, they're saying that, oh, we have a DU approval. That means that they plug this borrower's information into a Fannie Mae system that analyze their profile, and they are approved eligible based on the guidelines for that particular program. Okay, so it makes your offer that much, it makes it stronger. So that's important. So based on that, I know where your credit needs to be, or at least your score needs to be, in order to get that DU approval, especially if we're going in with FHA or VA and conventional. I do not give a pre-approval letter for a conventional loan unless I'm running you through the DU system. Very important. Don't allow anyone, whether you use me or use some other loan officer, whoever you want to use, just give you a letter and say you're approved. No, you need to make sure that they're running your information through the DU system. Okay, now, what do you need to how do you get there? How do you get, if you're not at the 640 now or above, how do you get there? Well, you need to have the appropriate history, credit history, okay? You need to at least have a a year of credit history, at least two trade lines, on your credit report, and on-time payments for 12 months or more. Okay, it's important if you're trying to qualify for a mortgage loan and you've got, let me give you an example. You've got, let's say, credit cards that are automatically paid every month from your bank account. So you're having them withdraw the funds automatically. You cannot set it and forget it, okay? Because you need to be paying attention and making sure that those creditors are accessing those payments from your bank account and are paying it on time. Because I'm gonna tell you right now, if you just set it and forget it and assume that those credit cards are being paid on time, okay, and they're not, you're not going to argue with the creditor. You're responsible for it. So now you're gonna have a late on your credit card that you didn't know anything about. Same thing with student loans, same thing with car payments. It's great that we set it and forget it, but we need to pay attention, especially if you're gonna buy a home, okay? Now, as far as revolving debt is concerned, that's what I'm talking about when I talk about credit cards. Those are revolving debt. That is the best way to increase your credit score. Installment loans are great. I mean, you have to pay them on time, because if you are late one time on an installment loan could be a student loan, a car loan, or a lending club loan, any loan like that, that's called an installment loan. A revolving account is a credit card account. Now, an installment loan is important that you pay it on time, because if you're late once, and when I say late, if it's due on the 1st of the month and you pay it on the 15th or the 18th or the 20th, technically you're late. You're going to get charged a late fee, but for credit purposes, you're really not late. Late is if it's due on the 1st of the month. Let's say it's due May 1st and you pay it June 5th, you're 30 days late on that installment loan. I have seen it pull credit scores down as high as, pull it down 80 points, okay, just by being late one time, okay? So be careful with your installment loans. I've had clients who, I'm making double, triple, quadruple payments on my installment loans to make my credit better. I go, well, hold your horses. That's great if you want to get rid of that installment loan faster, because you will. But if you're trying to boost your credit score, I'd rather you take that money and apply it to your credit cards to really lower those balances, okay? The reason is because if you can maintain a 15 to 20% balance on your credit cards, okay? And what I mean is if you've got $1,000 credit card, it's the beginning of the month now, you're using it, okay? Your next payment is due June 1st. Let's say you run up the credit card to $800. Just use it for normal stuff, gas, groceries, whatever you're gonna, take out of your bank account, use the credit card instead. Now, when it comes time to make your payment on June 1st, you've got an $800 balance, okay? Pay it down and only leave $150 balance or a $200 balance on that credit card. So your credit card company, that Capital One, is now reporting that you utilize that credit card and that you are maintaining a 15 to 20% balance against credit limit, okay? And they're reporting that to the 3 repositories. That will boost your credit score dramatically, okay? That's important, okay? That shows that you are really managing debt the right way. So use your credit cards as a tool. That's what I recommend. Use them as a tool, not a crutch. We have a tendency of using credit cards as a crutch because we don't have the money. I can put it on the credit card. That's not what credit cards should be used for. Credit cards should be used to play what I call the credit game. Boost your credit score using those credit cards, okay? That's important, and that's gonna help you improve your credit score over time. And like I said, with the young lady, we took her from a 596 to a 660 in 8 weeks. She had no lates, okay, none whatsoever. So it was able to go up quickly. I've got a loan in processing now. It's about to close this week. And when I pulled his credit in February, I pulled his credit the end of February. He had a 635 credit score. I was good to go for FHA with him at that point. I was like, okay, great. You're pre-approved. I got your DU approval. Okay. Then they made the change in the beginning of April to the 640 credit score. So I immediately got with him. We put a quick plan in that, a plan together, and I repulled this credit the end of last month, and he ended up with a 662 credit score because we paid down some credit cards dramatically. So when they reported again in April, it boosted up his score to where it needed to be. Okay, so there are ways of boosting that credit score, but everybody's different and everybody's situation has to be analyzed. Okay, now credit trending is something that Fannie Mae implemented for conventional financing. They did that a couple of years ago. And it's just to determine how you're managing debt. So if you have a credit card that you're paying perfectly on time, you're making that minimum payment every month, but that balance is increasing over time. You're not decreasing the balance dramatically. You're just making those minimum payments every month. You're managing, you're paying on time and your credit score is great, but you may get a refer with caution if we're trying to get you a conventional DU approval, okay? And we can get into that if that's the case individually. I don't want to get in too much into that. Now, how to avoid credit mistakes 12 months before the application. Simply what I said. Pay attention to your credit, pay attention to your payments, pay attention to your balances, use your credit cards as a tool, okay? Charge-offs and collections does not mean the end of the world. If you have collections on your credit report and charge-offs, that does not mean you cannot qualify for a loan. You may not get a DU approval with the conventional financing, but you can get a FHA or VA DU approval to get one of those types of loans, okay? And good thing about collections are not, we don't need to pay them off, okay, in order for you to qualify for a loan. I've had clients that even with collections, I had a young man had $24,000 total in collections, okay? But he had enough positive credit to offset the collections. It kept his score in the 650s, 640, 650s was his scores, okay? So he had enough positive. He had, car payment. He had some credit cards that were, he was maintaining low balances. So he had enough on his credit report to keep his credit score where it needed to be. And then we just had to hit him with 5% of the outstanding balance of collections towards the debt ratio. I'll get into that after, okay? Bankruptcies and foreclosures, not the end of the world. If you're 2 years from discharge, you can qualify for an FHA loan. If you're 3 years from your foreclosure sale or certificate of title, you're eligible for another FHA loan. VA is 2 years out of foreclosure, 1 year out of Chapter 7 bankruptcy. So it's not the end of the world. And like I said, everybody's situation is different. And it's just about taking a look at where you're at now. And if you're fine, you're ready to go, we move forward. If not, it's putting a plan in place, okay? Credit activity right before and during the application process. Like I tell all of my clients, the only thing, I just pre-qualified you, okay? The only thing from between now and the day that we close, go home, go to work, go home, eat a ham and cheese sandwich, and don't touch your credit. Leave it alone. Don't be like that gentleman who called me on Saturday. We were supposed to close that Thursday, calls me on Saturdays that he's at City Furniture. Eddie, I didn't take anything. I'm like, oh my goodness. He applied for the furniture. I said, now you have an inquiry that we're gonna have to deal with, okay? And the payment that he would have had would have, canceled the loan because his debt ratio would have been completely out of whack, okay? Don't do anything. Once you're pre-qualified, don't do anything unless you speak to your loan officer, okay? Any questions so far?
I actually can't see the questions. So I think I was gonna have that worked on with Paulina.
Okay.
But to touch briefly on when you were speaking on the DU approved eligible, basically the referral with caution would be a denial, right? For people that don't understand. what referral
Yes.
option is?
Referral
Okay.
caution for the denial. Yes.
And then just a little bit regarding credit and the current pandemic that we're dealing with. Where do we stand right now with credit requirements? Because I know that they may or may not have changed back and stuff. So can you specify or go into detail as to where we stand currently?
Well, where we stand currently is right. Let me give you an example. What's going on right now is that lenders, banks, and lenders are evaluating their risk.
Mm-hmm.
So one of the reasons why FHA and VA went to a 640 score is because of risk.
Mm-hmm.
You know, I'm just going to name a couple of banks. Chase Bank announced, I think it was 3 weeks ago, that they will no longer entertain any borrowers with less than a 700 credit score, and everyone has to put a 20% down payment.
Mm-hmm.
Wells Fargo, for their government financing, FHA and VA, no less than a 680 credit score. So lenders are starting to assess risk. There's some lenders that are uncomfortable with self-employed borrowers now, and they're requiring additional, they're enhancing their guidelines. For example, there's one lender that if you're self-employed, you have to have 12 months reserves. In addition to your down payment and closing costs, you have to demonstrate 12 months of payments as reserves in a reserve account, savings account or money market account or whatever. Okay, because they're trying to evaluate how much risk is in the market right now. There's so much uncertainty. There's so much unemployment. So it's changing day by day. So it's difficult to pinpoint exactly where we're at, because where we're at today, a week from now, we may not be there. A week from now, instead of 640, we may go to 660. We don't know.
Okay. So right now that option of FHA minimum credit being the 580, although it's not what we prefer and it's not the ideal, that's not in place right now, right? Because they increased.
It's not. There's a couple of lenders that are still.
I may have seen some advertisement about it, but I wasn't sure. I prefer your input on that.
There is a couple of lenders that are out there saying that they can go still as low as 580, 600. I haven't seen them close anything yet.
Okay.
And I don't know how they're going to insure that loan with FHA. So, and I'm not going to attempt to send them any loans, because one of these lenders, I'm not going to name the lender, when I used them in the past, it took them 2 months to close a loan. So I'll never send them a loan. But anyway, there's just a lot of uncertainty right now, but there is lending. We are closing loans. I mean, I've got, I think, 4 or 5 that are closing within the next week or so. So we are closing loans. It's just we need to
meet those criteria.
Exactly.
Sounds good. Let's move forward
Okay.
then.
All right. So income qualification. And lenders look at 2 types of borrowers, basically. You have what we call your wage earners, and you have your self-employed borrowers. Your wage earners are those who get a paycheck, pay stub, they get a W-2 at the end of the year. Those are what we consider, bread and butter. We can predict what their income is going to be moving forward, and their ability to pay the loan, okay, based on their W-2s, their pay stubs, and so forth. Very easy borrowers to qualify, okay? Then you have your self-employed borrowers. Self-employed borrowers, in order for an underwriter to determine a self-employed person's ability to pay on this loan, they need to review the last 2 years of tax returns. Okay, so you need to be in business for 2 years or self-employed for 2 years. Now, mind you, you can be self-employed and not necessarily, own an actual business. You can be a, independent contractor, get paid 1099, or have a company, but if you get paid anything other than W-2 income, you're considered a self-employed borrower. Okay, so you have to produce 2 years of tax returns, and they take your adjusted gross income for each of those years, add them together, and divide by 24 months. That average is what we use to qualify you with, okay? So that's the difference between a wage earner and a self-employed borrower. You need at least 2 years. Now, the reason why we're doing all of this is because of the debt ratio. We have 2 debt ratios that we have to abide by. We have the front end ratio and the back end ratio. The front end ratio is, let's say you're making, $10,000 a month in income. We need to maintain below 45%. So your mortgage payment cannot exceed 45% of your gross monthly income. The back end ratio is your new mortgage payment plus all of your other debts. For example, your car payment, your student loan payments, your minimum credit card payments that are on your credit report. All of that is added to your mortgage payment and is divided by your gross monthly income. That is called your back end ratio. We're talking about conventional, again, depending on credit score and so forth and risk, it could be no more than 49.5%. FHA can go up to 53, 54, 55, percent. It depends, okay? But that is the front end ratio and the back end ratio. Now, work history. Like I said, with self-employed borrowers, you need to be self-employed for a minimum of 2 years, okay? Wage earners, as long as we can document 2 years of work history, that's important. You don't need to be in the same job for the last 2 years. You could be work at a store, auto parts store, as a clerk or whatever, and you've had 3 jobs or 4 jobs in the last 2 years. As it's okay. We just have to document a 2-year work history. Okay. You could have changed careers, and as long as it made sense. For example, I had a borrower. He was a cook for a Cheesecake Factory and some others for 6 years. And 8 months before he came to me, he had switched to become a porter at a car dealership. And he told me, and the reason why he was referred to me was because they told him he couldn't qualify for a loan because he changed careers. I said, no, that's not true. So I sat with him. I discussed what happened. Why did you switch careers? What's going on? So he says, well, I was working 2 restaurants and they wouldn't give me full-time hours. And the reason why I went to the dealership is because the dealership hired me as a porter, making, $12 an hour, 40 hours a week with benefits. I go, that's understandable. And as long as you've got the new career for at least 6 months, we're okay. So we explained it. The reason why he changed careers was they were cutting his hours. Now he has a new career as a porter with a dealership. He's working full time. He's got benefits, and that's the reason why he switched careers. So we were good to go. We closed that transaction. So it's okay to have choppy work history as long as we can document 2 years. That's important. Part-time income, commission, bonuses, all of that is what we consider non-traditional income, okay? It's not your straight salary or your hourly or anything like that. It's non-traditional income. In order for us to use what we call non-traditional income, which is your overtime, your part-time income, your commission, your bonuses, we need to average the last 24 months of that income. Not 23 months, not 22 months, 24 months, okay? And that's what the underwriter is going to do. They're going to want to average that income for the last 24 months in order for us to use it, okay? Non-occupant co-borrower. You can qualify for a loan and to purchase a home using the assistance of a co-borrower who's not going to live in the home with you. That's what a non-occupant co-borrower is. Many borrowers can't qualify for, especially first-time home buyers. They're looking to buy something in South Florida, and they only make X number of dollars in income. They've got great credit, but they only make so much money. So they need assistance to qualify for more. So many of them use, their parents, their grandparents, their in-laws, whomever they want to use to be able to go on that loan with you. Go ahead.
I said abuelita.
Abuelita, yes. I mean, many times we've done that. So, and that person just has to have, decent credit and enough income to absorb their debts and add to your income so you can qualify for more. Okay. Now, this person is going to go on title with you. So be careful, because they will go on title with you. So they will be part owner of your property, although they're a non-occupant co-borrower. So choose wisely, okay? So student loans. I always like to talk about student loans because many people think that, my student loans are in deferment, or, my student loans are in forbearance, and so I'm not paying anything. Well, they made changes in 2015 where FHA no longer takes into account income-based repayment plans. For those that don't know what an income-based repayment plan for student loans is, if you have, $80,000 or $100,000 in student loans, and you feel that the payment is too high, you can submit an application with your student loan servicer to have them reevaluate the monthly payment. You can send them in, income docs and stuff like that. So you can have $100,000 in student loans and your monthly payment's only $50. Okay. It used to be we could use that $50 towards your debt ratio. FHA said, no, we're going to do 1% of the outstanding balance. So if you have $100,000 in student loans, FHA is going to hit you with $1,000 a month. Okay. Not saying that you're paying $1,000 a month. They're going to hit your debt ratio calculation with $1,000 a month. Okay. So they're going to add that to everything else for your debt ratio. Okay. So that's FHA. And if you're in forbearance with no payments, they're still going to hit you with 1% of the outstanding balance towards the debt ratio. Okay. Now, conventional did the same thing, but they changed. I think it was the year before last. And they said, well, whatever's on the credit report, we'll go off of that. So if it says $50 a month, they go off of that. Same thing if it says 0 on the credit report, but we can pull down statements that say $50 a month, they'll go off of that. Okay. So that's, student loans will affect your ability if we're going FHA or even conventional, because if your statement says 0 and the credit report says 0, Fannie Mae is going to do 1%. Okay. So student loans do affect your ability to qualify for a mortgage. So again, that's an individual situation, and we got to take a look at everybody individually. Okay. VA is different. VA is still the only one that, as long as you can show that your loans are deferred for a year or in forbearance for a year, you're good to go. Okay. So any
Eddie,
questions?
Yeah, we have a question.
Sure.
The question that I'm seeing is, can I buy a home FHA if I bought my home FHA last year? I'm the only one on the loan, and this new purchase that we're speaking of would go under his wife's credit.
Well, if you bought a home last year, and only one of the spouses was on the loan, you're both on title and it's your primary residence. So you can buy another home, but just because you only used one borrower for the first transaction doesn't mean that the other borrower can now buy a primary residence with their credit and and you can utilize the first-time home buyer again. No, that's not the case. Okay, because you're both on title and it's your primary homesteaded property, you utilize FHA. Now you can go from one FHA loan to another. There are certain requirements. Okay, so for example, if you're upgrading, let's say you bought a 3-bedroom, 2-bath home last year, and now you're upgrading to a 4-bedroom, 2-bath home. So you can demonstrate that the reason why you're buying a new home is you're upgrading. And FHA has a couple of restrictions. So if you're going from one FHA to another FHA because you're upgrading, okay, the current home has to have 30% equity, okay? So that's one of the requirements, besides the fact that you got to demonstrate that you're upgrading. And if you are trying to do that, then you need to have the ability to absorb both payments into your debt ratio. So they'll let you do that, but you need to be able to have enough income because you don't have it rented yet. So you need to have enough income to absorb both into the debt ratio. Hope that answers the question.
All right.
Not as easy as it sounds, you know, it just doesn't, there are certain requirements and guidelines, and, you know, again, you know, you have to understand, you know, that's understandable.
Make sure I'm not muted. And then just to kind of like piggyback on that, because I think me and you had a similar discussion about that. I feel like also it's partly because the fact that they're a married couple, right? And they're both together. Because in my case, me and my boyfriend are not married, right? So in that case, as long as the loan was going under just my name and the other loan was under just their name, would it matter if I'm on title on that property and it's a primary residence, even though we're not married?
Yeah, it still does. It still does because you're on title to that property, and it's homesteaded. Okay, so it's easier to do what you're talking about when you're in that situation because you could easily just quit claim yourself off that property. Okay, and then right. So I mean, it's easier to do it when it's like that, but you know, and again, you know, everybody's situation is different, but in that situation, it's a little bit easier to do that.
Because
Not when you're,
when you're married, no. And another question is that they bought I bought my house bank statements and I want to refinance. If I get paid W-2, how many months before I can refinance?
so you went from a bank statement loan and now you get paid W-2s.
How many months?
At least 8 months.
8 months?
Yeah.
8 months W-2 before you can refinance out of the bank statement loan into a traditional loan.
Correct.
Sounds good. I think that's all for now. I'll let you know if we get anything else. Let's go ahead.
Now, assets needed. When I speak about assets, I'm talking about the money that you have for down payment and for closing costs and possible reserves. I mean, if necessary. FHA, VA, conventional, depending on the type of conventional loan, you really don't need reserves, especially for first-time home buyers. Now, different types of loans require different types of down payment. The only lending that's 100% financing is VA. Now, I say that because I know that there's a lot of programs out there, you know, the 101% program, the 105% program, that, you know, it's not 100% no down payment program. Somehow that additional monies is being added to something, either a little bit of a second mortgage or you're paying for it in the interest rate or something. Okay. VA is 100% financing, no down payment. Conventional first-time home buyer is 3% down payment. Okay, that's, you know, Fannie Mae, Freddie Mac, conventional financing. You're considered a first-time home buyer if you have not owned a home for 3 years. So if I own a home today and I sell it today and I wait 4 years to buy another home, I'm considered a first-time home buyer again. Never understood that one, but that's the rule. So conventional first-time home buyer is 3%. FHA is 3.5%. You don't need to be a first-time home buyer to qualify for an FHA loan, 3.5%. So if you sold today, okay, and you're buying tomorrow, you can utilize the FHA 3.5% down payment, okay? And then obviously with conventional, if you're not a first-time home buyer, you have to put a 5% down payment. So that's where we get into, do I have the money that I need to purchase a home? What I always recommend, people always ask me, well, how much money should I have? How much money do I need to save? Well, depending on the purchase price, I always recommend that if you're looking for a home in the 300 range, that you should have at least 6.5% of the purchase price. So roughly about, $22,000 saved. Okay. That doesn't mean that you're going to need to use all of it for your closing costs. Okay. Because there are many things that, these realtors at Century 21 Global are phenomenal at negotiating. Okay. And really beating up those listing agents and sellers to help you with closing costs and getting you some assistance. Can it be done all the time? No. But often, they can get a little something to help you with closing costs. And then sometimes sellers are very motivated, so they're willing to give you money towards closing costs. So whenever you're getting seller concessions or seller paid closing costs, that's not costing you anything. The seller's taking it from the purchase price. So how much money should you save? Well, about 6.5%. Will you need all of it? Maybe not, or maybe you will. Okay, but that's a good target. 6.5% of whatever the purchase price that you're in the range that you're looking at. That's what you should be targeting. Okay. Now, have we had situations many, many times where we have our buyers coming in with just their down payment? Absolutely. Okay. But it's not guaranteed, and it's not going to happen all the time.
Those are those miracles, Eddie.
What's that?
Those are those miracles.
You broke up there.
Those are those miracles that we perform.
Oh, there you go. Yes. And you can get gifts from family members. Okay, so a gift, you can get a gift, and they can give you a gift for everything, for the down payment, for the closing costs. They give you a great gift. And if you have family members like that, just let them know I would be a great family member to have, because I could use a gift too. Down payment assistance programs. There are many down payment assistance programs out there, grant programs. Just keep in mind that, all these grant programs is not free money. Okay. It is an actual second lien that's going on the property. So for example, the city of North Lauderdale, it's a grant program that they offer for first-time home buyers, and they will give you up to $30,000. Doesn't mean they're going to give you $30,000. They might, but up to $30,000. Okay. But the city of North Lauderdale has requirements. That needs to be your primary owner-occupied residence, homesteaded, for a minimum of 10 years. If you try to buy that other house after 2 or 3 years, you got to pay that money back. So if you lose your homestead, if you try to rent it out, lose your homestead, or sell it or whatever, you got to pay that money back. Okay. So there are a lot of requirements for a lot of these different types of grant programs. There's income requirements, there's debt ratio requirements, even more restrictive than what the lender would give you. So if you are going the route of the down payment assistance or grant programs, we need to sit down and talk about which city you're interested in, whether they have money, because they may not have money at that particular time, and what are their, what are they looking for? What are their guidelines? And will that meet where you are? And then there's lender credit. Don't really want to get into that, but if need be, we'll talk about lender credit. Okay, any questions on this one?
I don't believe I have any questions at the moment. Eddie, but I did want to mention, whenever you go over this slide, because I know we've done it a couple times, and we're talking about the no down payment or the 0% down, and you're like, oh, VA is the only one that does that. Yes. I always think to myself, I was like, doesn't USDA offer?
Yeah, I never say that because
it's sunny South Florida, but I mean.
Yeah, I mean, we're in Dade, Broward, and Palm Beach County. There's no USDA here, so.
I can't get myself a ranch home with a big lot.
No, there's no USDA here. It's if you want to move to northern Florida, then we can look up and see if you're in a USDA area.
But also then you're licensed in the whole state of Florida.
Yes, I am, and in Maryland, and in Texas. Yes.
Exactly. So technically we could do that through a USDA.
We could do that if you're buying, but there's income restrictions with that. There's all kinds of, it's a different type of loan. And yes, it's 100% financing, but we're not there here. So I
That,
never really mention it because.
but you do loans in all of Florida, and our agents work in all the state of Florida. We just had Ron that closed in Fort Myers.
Right, which I don't think there might be on the outskirts of Fort Myers,
What I'm saying,
USDA
yeah, of
areas.
course. You know what I'm saying? Come on, Ed.
Yes.
You gotta sell it all. It's all in the portfolio.
Yes, yes, yes.
So,
All right, so just to wrap it up, the first step is to get pre-approved. Okay, it's almost like trying to go to the mall to go shopping, but you don't have a dime in your pocket. You have no credit cards that you can use. You have nothing that you can use. Okay, you need to know what you qualify to purchase for. Okay,
they have a word for those.
what's that?
They have a name for those type of people.
Window shoppers?
Yes, sir.
Okay, yes. So, and then, obviously, once you're pre-qualified, it's working with, a professional real estate individual that understands the needs that you need met with the property that you want to buy. Now, always keep in mind, you qualify for up to a certain number. It's your first home, so you kind of have to be reasonable and realistic about your expectations, especially in the South Florida market. And the real estate professional will really talk about that. Once you've found the property or properties that you're interested in, that's where you sit with the real estate professional and you're going to make that offer. You're going to send in that offer and you're going to have to give your deposit. Okay, because part of your offer is that the seller and listing agent are going to receive the contract, the pre-approval letter, the DU, desktop underwriting approval, to show that you indeed qualify for that program. But at the same time, any contract needs to have what we call consideration. Okay, you're going to need to give a deposit that's being held in an escrow account of a title company, saying, this buyer is making an offer on this property with all of these things, but in addition to that, here's an escrow letter because they gave a $5,000 good faith deposit because they're serious about buying this home. That's important. Those are all the elements of an offer, a good, strong offer. Okay, so you have to be prepared to make that deposit. Okay, and then obviously you're going through the negotiation and contract acceptance and so forth. And then the final details, which is the home inspection. You're going to go through different stages of your contract. There's going to be, as soon as your offer is accepted, you've got 3 or 5 days to make application, but all my buyers are basically making applications before you even go to contract. And you've got X number of days to get a home inspection on that property. And that's to check the AC system, the roof, the plumbing, the electricity, to make sure that it all meets your, again, unless you're buying a brand new home, you have to understand that there's might be some little deficiencies in a house, and talk to your real estate agent about that. But it gives you an opportunity to take a look at a home to see if there's any real major deficiencies, like a leaking roof, or AC system's not working, or there's poly pipes that might burst on you or anything like that. And you've got an opportunity to back out of the contract at that point within that time period. Okay, and then obviously there's an appraisal that has to be done. Century 21 Global Real Estate Professionals will not write a contract without the appraisal contingency, period. Okay, I've been doing business with Global for 4 years. I have never seen a contract without the appraisal contingency. What does that mean? That if you're under contract for a purchase price of $300,000 and it appraises for $295,000, you have the ability to go back to the negotiating table and say, no, seller, you need to lower it to $295,000. Otherwise, I'm walking away. So they always make sure to have that contingency in there to protect you as a buyer. So they have a good amount of time for the home inspection, the appraisal contingency, the loan commitment or loan approval period. Okay, so all of those stages of the contract to protect you and your deposit. Okay, and then obviously closing at the end if we get there. Okay, any questions?
I don't have, but yeah, that's pretty much true to the fact of the matter. Aside from the contract details and information, obviously, making sure that they're clearing conditions with you and also meeting, any requests you make for docs and stuff so that everything goes around seamlessly without any hiccups. But thank you, Eddie, so much for sharing your information. It's always so nice to see you, even if it's virtually.
Right? It's the new world.
Yeah, but I usually enjoy the in-person one more because we get some little food and stuff and personal in-person interaction. But we're gonna go ahead and we're gonna move forward. We don't have any questions. Paulina just informed me. So we're gonna move forward to Alma, who is gonna be talking a little bit about the current market. So take it away, Alma.
Thanks, Dayasi. Good afternoon, everyone. My name is Alma, and I'm an agent here with Century 21 Global Connections Realty. I would like to welcome you and thank you for joining us today for this first-time homebuyer seminar. I'm going to share with you some stats from Miami-Dade, Broward, and Palm Beach counties. The stats we'll be sharing with you are comparisons between March of 2020 and March of 2019. This year's March, there were 3,996 closed sales, which shows 9.9% higher than last year's March. The Quad counties reported 3,808 pending sales and took 5,215 new listings this year's March. With these impressive statistics, I do believe that despite the COVID-19, there are still people who are wanting to buy and sell their properties. Mm-hmm. Wouldn't you agree?
Yeah, I think that's actually a very good visual because, not only did the sales increase in the midst of this storm that we're dealing with, but there's people that still need to sell, which is the reason why we had these 5,215 listings. And there's still people that need to buy, which is why 3,881 pending. And, and Eddie mentioned it briefly when he was talking about, I think he said somewhere between like 5 closing that you're expecting sometime this month, Eddie. So that just goes to show that the market is still moving because, real estate is considered essential and people need to move. People need to rent, people need to buy, people need to sell, Unfortunately, no coronavirus can stop that.
Right.
No,
That's true, yeah.
Alma, I'm going to move forward to the next slide. Can you talk to us a little bit about the most up-to-date stats?
Yes, I do. Again, we are going through the Quad counties, Miami-Dade, Broward, and Palm Beach counties. Okay, the ones that we're going to share with you right now are from April 29th through May 6, 2020. For this 7-day period, there were 3,107 new listings that came on the market. Homes that went under contract totals 3,195, and closed sales totaling 2,548 just on this 7-day period. Just to update you as well, in the last 24 hours, the Quad counties reported and add new listings, 450 new listings, wherein 148 listings came back on the market. Additionally, in the last 24 hours, 359 sales went pending. Isn't that impressive?
And Alma, you keep mentioning Quad counties. What our graph shows here is the Tri-County, the Miami-Dade, Broward, and Palm Beach County.
Okay, Miami-Dade is one.
Yeah. Got
Okay.
it.
All right.
Just making sure that we're
Thank
talking
you.
about the same counties here.
Mhm.
And when you mentioned the 3,000 roughly properties that went under contract, just so that we can point that out to those looking at this chart right here, the Market Watch update, that is the 2,047 that went under backup, which is essentially for realtors in realtor term, also another form of saying pending, and then the 1,148 that went pending, correct?
Correct. Correct.
And this is just in a 7-day period in that Tri-County area, plus the statistics that you gave within the last 24 hours. So market is still moving, and like consumer confidence is coming back as we're hopefully declining away from this pandemic.
Yes.
Thank you again for Alma for sharing that information on the stats. I know we're going to circle back around with you towards the end. Now we're going to have Gerline Bavor. Okay, I have to work so hard on your name sometimes. And she's going to go over a little bit of why you should be buying, right, Gerline? I think you're muted. No, I don't hear you. And you're not muted. Nope. Nope.
Maybe on her computer she's muted.
No, I think she has like a speaker or something.
Hello.
There you go.
Ah, you're on. Yes.
Okay. Yes. Thank you so much, Eddie. I guess I'm pretty sure you guys have been receiving a lot of information from Eddie and from Alma, because it's true that we are dealing with something we're not used to. But when it comes to real estate, there's still things you need to think about it. So actually, I know a lot of people, probably some of you that's in the seminar today, are currently renting. I just want to bring your attention to when you're renting, what you're really doing to yourself. So if we take a look at this table, if you have a rent for $1,200 right now that you're paying every month, most likely it's going to be an apartment, roughly a 1-bedroom, or if you're lucky, maybe a 2-bedroom. So you're paying $1,200 every month. In a year, it's $14,400 this apartment is costing you. If you stay for 5 years, it's $72,000 you're paying for this apartment. And I just want to bring your attention. There's no way you're gonna live in this apartment for 5 years without a rent increase, because the owner gonna wanna make more money. Most likely after a year or two, they're gonna raise the rent. So I'm giving you a straight line. If the rent stay for 12 months, the way it is, for 5 years, the way it is, and if you go up to 15 years, you're paying $216,000 for her apartment. This is literally money that you're throwing away every single year. And all of this money could be equity that you are building if the house was yours. And I also want to bring your attention, because some people right now, they want to rent a single family home. Most likely right now, roughly, if you're lucky, you will find a 3-bedroom and 2-bathroom single family for $2,000 if you're lucky, every month. So every year you're paying $24,000 for this house that's not even yours. Think about it. So I'm gonna share with you some three smart reasons you should really think why you should think about owning your own property. First of all, when you do that, you're investing in your future. Monthly mortgage payment typically benefits you in the long run as you slowly gain more ownership over that home. You build equity and you also take advantage of the tax benefits. As a renter, on the other hand, your monthly payments go to someone else and you don't have any benefits after that. And second, you can also increase the value. You can also increase resale value and make a profit. As a homeowner, you're entitled to make any change you want to your home. As a renter, you can't. And any investment in a small home improvement project over the years can increase the home value.
I want to interrupt you there, Gerline, because actually, oftentimes as renters, they want to make changes to the properties to make it comfortable while they're living there. You know, whether it be painting or you know, even with Paulina and in our office, she can't stand the floors of the office. She hates them, and she tells me all the time, I'm going to change the floors. I'm going to change the floors. And I told her, no, you're not going to do nothing because you don't own this place and you're not going to add value to their property. And it's the same thing for residential rentals. Yeah, you're going to make it more comfortable while you're living there, but essentially you're not only throwing away the money in rent, now you're also throwing it away in improvements that you're making to the place that the owner's going to reap the benefits of, not you. So.
Yeah, that's a good point to this. But the worst thing is sometimes I know some people, they went the place, they even want to change the color. And then the owner don't want them to do that. There's certain liberty you don't have when you own someone else's house. That's what you need to think about. Exactly. And yeah, and then third, you can also use your equity over your home as a collateral. You can, if you short on money, you don't know, things can happen. You might be able to borrow against your home equity at a reasonable interest rate. You can also, the most important thing I think, you can also use that money to buy an income producing property and much more. So I really think this is the time for you to think about owning your own house, because it's an investment in your future, and then you're gonna make a decision to stop paying someone else's mortgage. And here, on the next slide, I want to share with you why choosing one of us at Century 21 Global Connection Reality is the best thing you can do right now. First of all, at the Century 21 Global Connection Reality, we make it our mission to take all the stress out of your real estate transaction. So we carry those stress for you. And we are also with you from the pre-qualification process all the way through until the day we hand you the key of your new home and beyond. So that's when after the closing, we're not gonna disappear on you. We're gonna still be there to help you.
We're gonna bother you instantly after you buy the home.
Yes, and then we make it easy for you in this pandemic era. We make it easy for you to show you property, whether you want it virtually or you want in person. The choice is actually yours. And at Century 21 Global Connection Reality, we have access to some of the best mortgage professionals. And you have the proof. You have Eddie. He gives you all the information you need right now. I have the proof. I don't even need to brag about it. So I just show you one of our professionals, what he can do. And we honest, we give you the most accurate information. We have also good connection with the most title companies and property inspector in the industry right now. So choosing Century 21, you will be in a good hand. We also create a family bond with our client. That's the most important thing. It's not only the transaction we want you to close with us, but we also, you have a friend for life. You decide to go with me or you decide to go with Alma, you do have a friend for life. And I do believe Alma has some new points she wanna add about the reason why you should make the decision to come with us at Century 21 Global Connection Reality. You wanna take it over, Alma?
Sure. Hello again. Now I would like to show you how Century 21 Global Connections Realty provides the tools necessary to facilitate real estate transaction in the virtual world. First of all, we will schedule virtual appointments for you and will send home markets analysis via email. We also make electronic signing easy on the platform. Our professional photographer will create a 3D virtual tour for your home. We will handle appraisal and inspection appointments for you. And we will manage virtual closing at the end. So that's all I have. And, you know, we are all virtual here at Century 21 Global Connections.
I think what Alma and Gerline, what both of you touch on, you know, maybe I'm biased because I work, you know, in Global Connections Realty. But I mean, Paulina is very adamant, especially during these uncertain times, you know, to still keep us productive while still following all the CDC guidelines, making sure we're taking the precautions. So when Gerline mentions that it really is your choice, it is, you know, we are all ready and prepared to either send you those virtual tours or have our photographer go out and do a virtual tour of a property you're interested in, or, you know, take the risk of going out and showing you in person if that's what it takes. You know, we're going to follow all the CDC guidelines. You know, we're going to have our masks on. We're going to sanitize our hands. We're going to allow, you know, we'll do most of the touching so you don't have to physically touch anything in the home. So I think that's all important. And then, you know, for those people that don't want to take those risks and have that confidence in us, you know, we have set up this whole virtual world where you can essentially buy a house, you know, and not risk any coronavirus or any virus for that matter. You know, I think those are all things that are very important. Eddie and Alma and Gerline, thank you so much for sharing all this wonderful information with myself and the attendees today. We have it recorded. We're going to send it to a couple people that joined in that weren't able to catch it all. And we're probably also going to put it on all social media channels because you know how Paulina is. And then if we can just go make Eddie, Alma, and Tommy, and you guys can share your contact information in case anybody wants to reach out, has more questions, or Eddie, if anybody's interested in getting pre-qualified with you, I know that you are available for about half an hour to an hour after this webinar exclusively for anybody that was on this webinar and is interested in getting pre-qualified. So if you can just share your contact information, how do they reach you, Eddie?
Yeah, you can call me or text me at 954-397-9454. Again, it's 954-397-9454, or you can email me at Eddie, EDDIE, @uhlcorp.com.
Perfect. Thank you so much. Alma, beautiful.
Hi,
Alma, if somebody needs to contact you, where do they reach you at?
They can reach me or by calling or texting me at 954-498-4387. Again, that's 954-498-4387. And my email address is almatommyrealtor@yahoo.com.
Perfect. Thank you. Gerline, me and you were matching today with our salmon pink colors.
I didn't get the memo.
Eddie and Alma didn't get the memo.
No.
We gotta do about this next time. How do they contact you if somebody wants to go and see that beautiful background that you have? I have my skyline. You have a building, so.
You know, I love the beach, so that's why I have that background. So if someone want to get in touch with me, my phone number is 954-347-3322. 954-347-3322. I just want to mention that I speak English, French, and Creole, and then some Spanish. So, and then for my email address is gonna be G with my last name, Beauvoir, 224@gmail.com. Okay, if you guys have any questions, do not hesitate to reach out.
Thank you so much, guys. I'll go ahead and I'll put your contact information that you shared on the chat for those people that inquired. And when I share the webinar, I'll also send it over to them again. But I think, oh, look, I was finally able to open up the chat. I was like, I couldn't see it the whole entire time. So I had Paulina filtering me the questions because I'm like, I don't know where to see it. I don't want to touch anything. I did that once and we skipped a slide and I was like, oh, hopefully Eddie didn't see that. It went back. But thank you again for being here with us. And thank you to all the attendees and everybody that was online with us to watch our seminar. We hope you enjoyed it. We hope you found great information. And we look forward to doing this again next month, right? Yeah, next month. So thank you and have a great day, everybody. Bye.
Thank you.
Oh, I'm sorry. Before I interrupt, I also forgot that this Sunday is Mother's Day. So happy Mother's Day to all the mothers.
Happy Mother's Day.
That's right.
Happy Mother's Day.
Have a great weekend.
Bye.
Bye.